Welcome back to Vantage. You may notice that I'm in somewhere new. I'm actually visiting the offices of the manager. The reason I wanted to do this one is that we're a couple of weeks away from the UK budget. Are we going to hear something that's going to set the UK small cap market alight? We thought it'd be really interesting to talk to a small cap specialist. Let's go take a look. Welcome back to Vantage. We're focusing on the UK small cap sector, and I'm delighted to be interviewing one of the most prolific small cap investors. Great track record. Welcome to Vantage, Richard.
Oh, very good to see you, Neil.
Thank you. We've seen quite a lot of interest in UK stocks. What do you see the sort of main catalyst for investors in UK stocks starting to move down the market cap spectrum where you're looking?
Yes, well, you've touched on what's been happening this year already, in as much as FTSE 100's really been motoring. I think in dollar terms it's up 26% at time of this recording, US being up significantly less. So this was the investment for this year was FTSE 100 or Europe as well. Clearly that hasn't filtered through into UK small caps much yet, and definitely not in the same degree. So there's two things that can happen here. So firstly, people historically would start to feel, as the performance continues in FTSE 100, the gap becomes too big and you get switching, you get people starting to take a bit of profit, maybe switch a bit of money into small cap. That doesn't usually create huge amounts of flows, but for active managers, that will start to entail if you have an all-share mandate. I think, secondly, though, it does actually require the metrics to get small cap going, which is probably interest rate cuts. And I think one of the reasons we haven't followed large cap is because there's been this sort of sustained slightly higher inflation, and as a result, people are cautious about the pace of falls in interest rates, and that's what sort of held people back going into UK smalls. I think that said, the Americans are looking, trade operators and PE-backed businesses can still see the value and are doing things about it. I mean, I think we will look back on it and go, crikey, did Spectris really get a bid at 100% premium from private equity, and then another private equity house have a bidding war about how much they would pay for it? I mean, it just sort of shows you how much value there is in the wider market. I think, though, all the ingredients are there now. The valuations are low. We've been saying that that's not a catalyst in itself, but that's a precursor for a market having a good period of performance. The performance being poor in small caps, actually that's quite good if you think about it. It's quite dangerous buying a market that's performed for a long time, done really well. That's not the case with small caps, so that's a good. The balance sheets are strong, both for consumers in the UK. And I think what we really now need is just a little nudge from government to get things started. I think that's the missing piece in the cake. We just kind of need Rachel to turn the oven on.
Okay. Yeah, you sort of you thought through what I was going to ask next. So there's been a lot of noise about reform in the UK market, and that's been around for 2 or 3 years now. What do you envisage are the sort of regulation changes that are most likely to increase investor appetite for the UK and in particular for small cap?
Well, I think on the regulatory front, there's actually been quite a lot done already. It's quite dreary. It's not very good journalistic stuff that there's been changes to the listing rules, that the regulator has now been given a second objective of being focused on competition and growth and the economy, not just regulation, that there's been subtle changes to how investment research is paid for. I mean, personally, I think the horse may have bolted in that, but at least they're recognising that wasn't a very worthy development under the old MiFID rules. So there's been quite a few sort of regulations that have happened, and I don't think, if you look back over the last 20 years, we're a well-regulated. It's not really our setup here that's in itself a problem for for investors. I think there's been concerns about our political setup in the UK, Brexit, all that sort of stuff, which sort of puts some people off, and clearly the domestic economy has been weak. But I think what's required now is probably less regulatory reform, but maybe some tax incentives to just kickstart reinvestment into domestic equities. I think you've reported a number of times about how probably you can use the word disgraceful, the allocation of our own domestic pension funds are to our domestic stock market. I did read there was a survey recently, which I think was really interesting, that said that most people, when asked what proportion of their pension that they probably don't check very regularly, that they're building up is in UK equities, the average response was about 43%. The actual reality is about 4%. So people think they're invested in the UK more than they actually are. So I think what we're expecting is that Rachel Reeves is seriously looking now at weaponising ISAs back into the UK stock market. That would be a massive positive for UK stock market. We get billions back into the UK just from ISA reform. And there's also sort of leaked or kite-flying policies with regards to getting pension funds back in, whether it be local authorities, which they can lean into from a government perspective, or DC schemes, which is will become the biggest pot over the next 10, 15 years, saying maybe the default option is to have a bit more in UK. And if you really care, you can tick the box and say, I don't want any UK, but maybe the default is to have a bit more than 4% going forward. Just to remind you, we are, of all the G7, we are the lowest, of all the other countries, we have the lowest exposure to our own stock market, which is still one of the biggest stock markets in the world. And some of those other countries are very quite undeveloped or less broad and universes of stocks to invest in, but still they find a way of investing in those Australian or French or German or American stocks, obviously the latter being the easiest one to get behind.
Yeah, no, look, you're right. I made a call about a year ago saying it feels like you can't get much lower, so it feels like any change incrementally will be positive. So let's see what she says in a couple of weeks' time.
Yes, yeah.
Okay, so we talked big picture. Now let's get into the trust that you manage. A Rockwood Strategic. What is the overall investment objective?
Okay, yeah. So we're trying to find investments that we think can deliver 15% IRRs over a holding period of about 5 years. Yeah. And you know the maths, Neil. What that means is if you compound at 15% a year, you double your money in 5 years. So we're looking for stocks that can double. The outcome for the trust, if we achieve that, will be slightly less because we've got to take some costs off that for running the trust. But that's essentially what we're trying to do. And by doing that, we're trying to capture the small cap effect, which although has been difficult in the last 2 to 3 years, the long-term effect going back to 1955 is really, really positive. So we're trying to capture that for investors. I think the final piece is we're trying to capture businesses. It genuinely is part of the objective that we find businesses where will benefit from operational, strategic or management changes or evolution to unlock, recover or create shareholder value.
Yeah, okay. I wouldn't say you're necessarily an activist, but you do get involved in, the guidance of the companies. I've seen that. For investors less familiar with Rockwood, what are the main features that you want to draw people to for the trust, and what sets you apart from sort of the peer group and the competition?
Okay, I think big picture, it's really important to remind people we are an investment trust. Yeah. So, and why that's important is we've got permanent capital, so I can genuinely take a medium-term view. The majority of money that's invested professionally in UK smaller companies are by open-ended funds who have daily liquidity requirements and are thus kind of stopped by their liquidity requirements of vesting in really illiquid small caps. They're basically told by their risk departments, you might need to give us our money back tomorrow. This is too illiquid, you can't invest in it. So they miss out on these opportunities because they haven't got the right liquidity profile. In terms of then how we go about it, the average, I think, UK smaller companies fund has sort of 50 to 70 holdings. We only have 25. So we're a concentrated approach, and the top 10 holdings make up over 60% of the NAV. The third piece is that we're actually value investors, and we have quite a recovery kind of style to our types of investments we make. That's differentiated because most small cap funds are a bit more growth orientated. They're trying to find sort of multi-year growth stories. We're trying to find multi-bag recovery stories and just make money. Now, some of our businesses do end up being growth companies once they've been sorted out, but our style is quite differentiated as well. And then you touched on before, I think the third aspect is this sort of engagement approach. So we actively take stakes. We have stakes over 5% in the majority of our holdings. We've got 10 board positions, which have either, some of them are literally, they're a Harwood board position. A number of others are people where we proposed really good candidates on behalf of all shareholders, but they're people that we trust and know. And then we do engage constructively with our investments, and that takes time and effort. And quite a lot of fund managers, particularly if you've got 70 or 80 holdings, it's quite difficult to do that kind of work. So that kind of differentiates us too.
Okay, and we're shooting in your offices. I'd be curious as to, as you go about this, what resources you have at your disposal. So not just what I've seen in here, but within the network that you have as well.
Yeah, sure. So at the Rockwood level, so despite the fact we have really low turnover, in fact, I don't know the stats, Neil, but I would be happy placing a bet. We've probably got one of the lowest portfolio turnovers of any small cap fund. Because of our nature of we hold stocks for the medium term and we don't trade stocks. Despite that, we have a full-time dealer who's very, very experienced. And why we have that is because the nature of this investing, you need to be able to get blocks, large stakes, get out of large blocks when the time becomes right, and also do that without leaving a sort of breadcrumb trail that everyone works out you're trying to buy into a particular stock. So that's a really helpful resource for me. Secondly, I have an assistant manager, Nick Mills, who's now a very accomplished and experienced research analyst, helps me directly on Rockwood. And then in addition to that, we've built what we call the Investment Advisory Group. It's got 6 people on it, and they're all very experienced investors. In fact, cumulatively over 200 years of experience. I mean, there's a little bit of a sort of marketing line adding up people's days because 200 sounds lots. But if you take Christopher Mills, who's on the advisory group, is one of the most experienced investors in the UK. Richard Pease is on, who founded European Equities for Henderson and also for Jupiter, and founded Crux Asset Management. Adam Parker, who was one of the founders of Majetti Asset Management, building it from nothing to 15 billion under management. These are great resources for me to draw on. And I share investment ideas I have, companies that I'm due diligencing on to get their insights, concerns and their networks to add to our due diligence process. I think finally, you mentioned that the building, the Harwood tentacles and network are pretty exciting. I think actually, because we have various funds here in small cap or that's in the Harwood family, like the Edison Investment Trust, and Christopher's own funds, we actually we've probably got a bigger small cap team than most firms that would be household names. But also, I think really importantly, we have a private equity team at Harwood. We also have a private debt team, a property team, and actually more recently, we brought in a global equity team. And it's very much a kind of, it's a wonderful cauldron of ideas and people that love stocks and making money in this building. And that's really helpful for me, particularly the private equity, sort of understanding that relevance to the stocks that we're in, which in some way, some of them, because of their liquidity or size, are almost like a private investment.
Okay. And if you're taking on sort of a new holding or in the trust, I mean, and you can illustrate this with something if you want. What are the attributes of an ideal new holding for you?
Right. So sort of the perfect holding, the perfect investment opportunity is one that is at a deep discount to intrinsic value. Yeah. So we can see that the business is significantly under the value today. The importance here for some investors or some of your audience that might not think about this in these terms is a value investor thinks about what we know today as a value and getting it cheaper than that. We base that value mainly quite a lot of backward looking about how the business has performed in the past, what assets it already has. And a growth investor thinks more about what a future value might be if the company goes on to grow, and then has to sort of guess its growth rate more. That's the nuance. So first of all, we're looking for deep discount to what we think is the value. The second thing is typically something where the earnings are depressed, but where there's been a long history of decent profitability, decent cash flow generation. Yeah. And the reason why they're depressed is because of maybe some own goals, some poor management, maybe some strategic error, or maybe even just industry change that they've been slow to adapt to, but everyone else has done. So it could be resolved. So we can see that opportunity for a recovery in earnings without having to sort of believe that they're, got some new whizzy science or, solved quantum computing or those sorts of calls which other investors have to make. Now, ideally, I'd want all of that with a rock solid balance sheet with net cash. And actually in Rockwood, over 10 of our holdings have got net cash on the balance sheet. But if we can't have that, because of the problems, it's not the case, we will look for stocks where we can see a pathway quickly to resolving the financial risks. So we take out the financial risk to equity investors in the thesis. If I was if it was sort of Christmas come early, I'd also want the shareholder structure to be one that will enable change. So some companies have all those characteristics, but maybe there's a very large shareholder already who's going to block change for either behavioural or bias reasons, and that will maybe make it more difficult, put us off getting involved. So we like a kind of a mixed register of sensible people that are probably a bit upset generally and are up for a bit of change.
Yeah, no, it makes a big difference. You've told us what the sort of ideal holding is. Now let's do a little bit of a rocking chair test, okay? How's the trust performed? Walk us through it and, what's been sort of driving that sort of performance and how repeatable is this process?
Yeah, I think repeatability is definitely a really important thing to talk about because we have had a really strong period. So our interim results are out shortly or may even be out when this is released. And in the 3 years to the end of September, the fund's NAV will be up about 94%. Okay. Just to put that in context, AIM would have been down 2.9% during that three-year period. Now, if we go back to what we were discussing earlier, if I'm targeting stocks that double over 5 years and 15% a year, at 94 after 3, we're actually tracking ahead of our target returns. Yeah. It's quite important for people don't extrapolate that level of outperformance, but everything's been working really well. When I say everything, we've had quite a few things go wrong as well. But on average, you get the portfolio outcome, not each individual stock outcome. So that's been really, really good. And I think over the last 5 years, our NAV is up over 200%. The repeatability, I think, is really important. So what sits behind that is, does value work? Will buying stocks at a big discount to our view worth continue? Well, we would say yes, and that can last forever. I think what's a really important piece about our style is the behavioural and emotional side of investing. And as long as we're still all people in markets, now we know there are quite a few computers in markets now, and passives that don't have a brain as such, as still as long and active people in markets, they'll behave behaviourally. They'll get overexcited, over-exuberant, and bid stocks up to far too high levels. But for us, most importantly, they'll get overly depressed, overly pessimistic, really unhappy. And you've got to kind of believe that people won't do that in the future because when we're buying these depressed stocks, we're sort of exploiting those behavioural traits, but being able to take a more medium-term view. So I think that allows us to be repeatable too. And then, so I think that's why it will continue to work.
Okay, and you touched on things do go wrong, right? So let's talk about, outside of stock selection and the due diligence processes, are there specific risks to the performance record, etc.? And what do you do to sort of mitigate those?
I think the most important thing is what is risk? Yeah. So a lot of people actually never really sit down and go, what is risk to me? And it's you can ask a number of people and it's all you get a different answer. The one word that does come up quite regularly is volatility. Yeah. Even despite people being able to say, well, actually, I'm saving for my children's inheritance or my future pension in 20 years' time, but I sort of struggle with the volatility of how much my wealth is over the time. Now, there's no doubt when you have a concentrated portfolio like we do, and we're taking sizable investment positions, that you could get volatility in performance for any over shorter time horizons. And I think that's really important. People have to understand, because if we have one or two VARs go wrong in quick succession, we're sure we'll have others that will make up for that, but they won't make up for it the following week or the following 2 weeks. So I think that's first. I think secondly, there is a liquidity risk within our approach. We are taking illiquid positions, and if we get them wrong, which sometimes we will, they are what you could call a potential lobster pot, easy to get into but quite difficult to get out of. Now, we'll work really hard at Harwood for getting ourselves out of those positions. We might agitate to get the business sold so all shareholders can get out of their positions, but that isn't an easy job. So I think there are times when that might affect the strategy. I think it's probably fair to say, so I'm managing the fund, so you've got kind of person risk, because anyone that took on Rockwood after me would probably go about things slightly differently, or and approach things slightly differently. I'm not into extreme sports, Neil, but and I'm fit and healthy, but just everyone should be aware of that. And I think finally, for any UK small companies fund, we still do have a decent domestic bias. So the FTSE 100 has been going up, but quite a lot of the stocks leading that have, a big international businesses. In Rockwood, we've got loads of overseas exposure from some of our smallest holdings like Cooth, which runs the mental health for children service in the state of California, to James Fisher, which is selling defence equipment to places like India and the US, as well as obviously the UK, to a range of internationally exposed businesses. But we still have quite a strong domestic bias. So I think everyone, that means we can still navigate that. But if the UK economy consistently remains really rubbish, it's not the best backdrop relative to some other economies that might be more vibrant.
Yeah. Okay. And you've taken time so those who do look at Rockwood would have noticed that you've got a new website, which looks really great. I mean, but if you had to direct investors or sort of potential investors in terms of the resources available on the website, what areas should they be looking at?
Well, probably two aspects. Firstly, just the info. So we've loaded up lots of interviews, all the annual reports, fact sheets, and the presentations going backwards, and we do that every quarter, so you can quickly get that information. Secondly, a new feature we've put in. I mean, we've probably joined the rest of the industry maybe 20 years late, but we've got a new mailing list, which will be, I think, helpful for making sure you sort of get Rockwood. Now, we're not going to bombard everyone. Everyone's got too many emails anyway, but I think that's something we'd like people to start signing up to, so we can speak to people that really care about Rockwood. And I think the third piece is that we've spent some time explaining in more depth than we've had time in this interview about our philosophy and our process and how we think markets will work. And I think quite a few actual fund managers and houses, their philosophy needs to be so broad to encapsulate all the people working there that they don't really have one. But we really do. So it's explained in full for those. Why do we go about running Rockwood the way we do?
Okay, Richard, it has been a pleasure having you back on Vantage. Thank you very much, and I would encourage people to go and have a look at the website. There's some great material there. And we look forward to catching up at some point next year just to see how the performance has developed.
Well, thank you very much, Neil, and thanks to everybody at Edison that's been supporting the strategy.